big market guest. Samir Arora is now with us, founder and fund manager at Helios Capital. Samir, what do you make of the markets, the range-bound move that we are in? No follow-up buying, any global bad news, and markets tend to correct.
Well, you're being very charitable in saying that the market is range bound because I think it's falling quite a bit. And generally, I would think that, which I've been saying for since Jan, that till the US market settles down, and what will we call settling down, I guess, would be if it stops reacting to any bad news. Sometimes it is on a stock, sometimes it is on inflation front, sometimes on a comment from the Federal Reserve, any of the governors. All that has to stop or be moderate, and then you can be bullish. And I don't think we can be bullish on India without at least that market stabilizing.
That's okay, Samir. Your pink shirt is giving us some hope that the markets will get back in the pink of health at some point. But anyway, that aside, Samir, I was chatting with Chris Wood yesterday, and he said he's only going to increase India weightage if the Nifty falls to 14,000, 14,050. He said we haven't fallen much and we're fairly resilient. Do you actually see that kind of selling even from these levels, another 2,000 points on the index alone?
So that means around 10 odd percent, right? Yeah. So 10% we are supposed to say as fund managers that can happen anytime and mostly without any reason also sometimes. So 10% fall, even if it is the best of times, worst of times, if somebody says, can it fall another 10% or can it fall 10% anytime? Absolutely, anytime it can happen. So there is nothing much in that. But right now, the momentum would carry it for a few more percent for sure. So I think let's look at it differently. Let's look at it that either the world and maybe a little bit India has to fall or time has to pass. And then we negotiate 2 or 3 things. First is we negotiate what happens when actually there is quantitative tightening, number one. Second is we little bit see what I was saying, which is that you're not reacting to every news and that this volatility of the US and maybe a little bit Indian market going up and down 2% every day, more US than India. But please understand that also a simpler thing for the Indian public to see is that every day we cannot handle a 2,500 crore selling by FIIs. And you cannot just handle it. So therefore, it will always be under pressure till that goes down a little bit or becomes much less. And actually one day it will be positive. My guess is that these things will take 5-6 months. Now in these 5-6 months, you can either not add new money or know that you are adding it for a 3-year view or buy a particular stock. Or mostly, as I just heard your guy saying, don't do anything for a few days, weeks. It doesn't matter. There is no ego in saying that I bought it at the bottom. I have seen this ego being presented again and again on Twitter that we bought these stocks in March of 2020. I think that was the height of foolishness to have done it, but it worked out.
Well, Twitter is another story. But anyway, Samir, are there opportunities like an odd ITC, which you picked up, which didn't move at all, and then look what's happened to ITC from there? Is this market throwing up those kind of opportunities? Or some stocks which are now so beaten down, you think that the scope of downside may be limited?
So the thing is, we are also not able to control ourselves. And even though I keep saying I'm bearish, even yesterday we added to HDFC Bank just for everybody's information. So the point is, once in a while you feel like buying, but when we say we are negative, doesn't mean everybody freezes. It means you are cautious, you are not excited, you are not spending the last dollar today to say, I think that my stock has reached a certain whatever level. But broadly, if you look at it, the correction in some of the stocks, I think that these stocks will fall another 20-30%. So the way I'm looking at it, at least from my long short fund, is that I want to short stocks where if the market turns, they are not going to, blow out of this thing, but that maybe you lose a little, but most probably they will fall another 20% kind. And these, according to me, are stocks that have been massively re-rated because of maybe easy money or a feeling that these stocks deserve to be 100p and 70p when they were trading at 30p's in the past. and they are more steady. You can make money more steadily by being out or shorting them. But on the other side, we have bought a few new stocks in the last 5, 6 months. ITC, of course, we bought in January. But broadly, it's not that there are some great values that are out there. You will turn bullish when the market is a little bit stable, is what I think. For the last 10, 12, 15% that we may have, if we had zero money, all these things would be great starting points. But this is not that we are investing our first dollar now. So no need to get excited.
Obviously not. So besides HDFC Bank, what else, Samir? Or what are you tempted to buy?
No, this is what we bought just yesterday.
I know, I got that. But what else are you tempted to buy, or at least keeping on your radar?
If you look at it, see what we thought in the last 2-3 months is that financials we already have a lot, mostly. And tech is the most connected to the US. And in some sense, you could say that these valuations have fallen, but you could also say that, they used to trade at 20s and now they're trading at 25, 30 kind of multiples. So we said, okay, let's not buy a little bit more of that also. So then there was left consumer for us, which are the three themes. Now, in the consumer, there is one group which has got commodity as a big input, which is mostly these consumer durable discretionary type companies, where it is very easy to connect it again to the world and see that because in India we haven't got this recent information, but in the US we have seen what happened to Target and Walmart and all these places, that the consumer durables nobody's buying, and the logic is the same worldwide, that the home improvement and all that happened in the last 2 years while you were sitting at home, and in any way commodity prices are up, and forget about the buying of commodity, buying the company, that these guys are most affected by commodity as an input. And also when the prices are high, it reduces the affordability a little bit. So then what is left in the consumer is the consumer spending small amounts of money, mostly because of pent-up demand or because he has been kept in his house closed for 2 years. So he's going out to malls and he's going to QSRs and he's going to movies and they are going to hotels. And in all of these, there is less influence of the commodity hike also, and it's a smaller spend. So we have basically bought 3-4 of these in the last 2 months or 3 months maybe.
Really enjoy reading your tweets as well. And you had said just a few days ago that if your investment philosophy is to be flexible, then no one can accuse you of changing your philosophy with changing times and markets. So is that what you're adopting?
No, so what I mean by that is that you have to, for example, we are all bottom-up investors and we say that, we don't know how to predict inflation and we don't know how to play wars and all that. And I'm also like that. But when you're in the middle of it, all it took was a few weeks of learning. And therefore, from January, I've been saying that this inflation is beyond normal. But if you had asked me that in November or December, I would have said, I don't know what is inflation in the US and how do I care? Plus, anyway, how do I predict? But once you're in the middle of these events, you cannot go and say that for example, if you look at 100-year history of the US, of any market, and you say that wars are irrelevant, because, if you look at it, World War I will look like some small dot and World War II will like some small dot, because over 100 years, the market has gone up X 10, 12% per annum. But if you're in the start of a war, then can you say war is irrelevant? If you're in the start of when some Federal Reserve guy is saying that we are behind on inflation and the inflation is 8 and we will take draconian measures, as he said, can we say inflation is irrelevant for our decision making? So I mean that way, that you have to be flexible. Once in a while, you may even have to buy a commodity company if you feel there is a case, and maybe only to hedge yourself. If I have 100% to be invested and my goal is to beat a benchmark, and once in a while, there is a story for that commodity, except that I don't totally relate to it because my background is different, my experience is different. But there is a case, let us say, I'm not saying I don't have any, but if you buy 5% of that commodity stock and say that, okay, I will neither add or subtract value on this relative to index, but I'm covered, and I will now try and do what I can do with the 95%. So what is wrong with it? So you're flexible, because all your life you never wanted to buy commodity, but you bought a 1 or 2. So how does it matter to be saying all your life as if it is a great highlight of life that I don't ever change? Look at the biggest hero of the world, Stanley Druckenmiller, who is a genuine hero, by the way, in the investing world, with 30% per annum returns over 30 years, and his own net worth being more than $10 billion. Look at the flexibility that all these guys have in doing whatever they want. We just get prisoners of our images. And I want to not be, but even I am, because I do India and I do, equity, so I can't be overly flexible. But mentally, at least you have to be.
I mean, if you mentally had that flexibility in a very utopian environment, if you were sitting on cash, what would your portfolio look like? Give me like 5 to 6 names.
Oh, you mean stocks? No,
Yeah.
Stocks, we have, our theory is very simple, that there are basically in any year, any period, slightly less than half the stocks that are going to outperform the benchmark. And that is to do with arithmetic, that if there are 100 stocks in a universe and our job is to beat the average, then the average will lie somewhere in the middle of that. It is just arithmetic. You're taking an average return of 100 stocks to calculate the index, and it'll be a little less than half most of the time, because some larger companies will have a higher weight. And so basically all you have to do is take a stock and say whether it's this side of the half or the other side of the half. And any stock you get on the right, on the correct side, you will beat the index. And as many you can have, you beat it more. But from our point of view, there are two angles that work. One is that, okay, are we beating the index or not? But once in a while, when the market is down a lot, there'll be a second pressure saying that, why is it in absolute you're losing money for investors? So this is the other angle that you have to work upon, which is a little easier in the long short fund where you can short and all. But if you say I have to buy only 5 stocks in the world, well, I have more than 5 stocks currently, and I feel I am not being forced to buy anything. So from India, my biggest holding, as I said, we have made it to the limit that we have yesterday, is HDFC Bank. In the US, we have Google and Amazon. And there at one point, we had 60% cash, but we couldn't control ourselves. So now it is 40%.
How would you essentially play this entire oil theme? Oil has gone up. Some of these oil stocks have done well. A company like Oil India, ONGC, completely neglected. Any interest in oil-related players?
No, even though it hurts us. But because, very rarely do we buy commodities, and even more rarely, or actually less rarely, do we buy PSUs. And PSU commodities would mean that absolutely we are starting our life from zero. And whatever we say, we are an outcome of what we have seen for 25 years. And this is not a strategy that we can easily follow. That would mean not flexibility. That would mean shamelessly chasing the latest idea.
I had said, Samir, at one point, if I'm not mistaken, with respect to LIC, that, it could do well, but look at what's happening to the stock. So what's the outlook? For the long haul, it's one to bet on?
So we didn't buy it in the end. We said it's a good idea, because in the end, by the time the IPO came, that I think it was in May, right? So the market was really bad. And then, but fortunately, I had decided this, that no more do I want anchor. If I want, I'll buy it on the last day. I can sell it on the first day if it so happens, but we never ended up buying it. Right now, the problem that happens with all these IPOs is that when they fall below the IPO price, basically they waste a year or 2 years of their life, because everybody hates them. Then there is an overhang of the anchor. Then there's an overhang that by now, anyway, you have spent 3 months only. 8 months later, government may again sell in this case. On the other case, private equity funds may sell. And that's why I tell this thing that every promoter who comes, at least whoever asks me, then make sure that the price after IPO is a little bit higher than the IPO price. But in this case, I really thought it was actually a good price, in the sense that the government had been flexible in not holding on to their initial whatever they thought about the price. But the market in that sense is quite bad, obviously. That's why it's not even done that. But it'll take time now. Everything takes time when it goes below the IPO price.
Samir, before we let you go, tell me, what headline would you like for Twitter?
All I don't want is daily morning wrap or whatever, market wrap.
We will dig out a nice one. Don't worry.
Message it to us first before we put it out.
Okay. Social media editor, Samir Arora. But anyway, good chat.